Hello, and welcome to McQuilling TV. I'm Claire Schmidt, and joining us again today is Connor Stone, Marine Transport Advisor with McQuilling Services. Glad to have you back on, Connor.
Thanks for having me, Claire. Glad to be back.
Congratulations on the publishing of the 2019 to 2023 Tanker Market Outlook. Could you explain to our viewers some of your findings in the report and what your expectations are moving forward?
Sure. So from a dirty perspective, ton-mile demand for crude and residual fuels transportation increased by about 1.9% last year. And we're expecting that to decelerate to about 1.1% this year. And that's mostly due to a reduction in crude supply from OPEC, which is actually contracting the Middle East crude balance for export by about 1 million barrels per day. And adding to this impact is some new refining units coming online as they expand their refining centers. So we're going to see some pressure on Middle East volumes, particularly to the west. We expect the AG U.S. Gulf trade to fall by about 3.5% this year. And then regarding volumes to the east, they'll be a little more preserved because the Middle East producers are going to try and secure that market share. So we see that trade growing by about 3% this year. Now, for West Africa, this is going to be beneficial, because, especially for VLCC demand, because you're going to have a narrowing of the Brent-Dubai crude differential, so you're going to have more of an Atlantic basin pull to the east. So we're expecting demand from the West Africa to the Far East on VLCCs to grow by about 2.5% this year. For Suezmaxes, this is not so great because you're going to have lower demand on TD20 because there's going to be less crude available for refiners to take. But we see them substituting some of this with more barrels from the U.S. So we expect a little more transatlantic trading for Suezmaxes between the U.S. and the UKC. Now, regarding the Venezuela situation right now, a lot of market participants are suggesting that the lack of Suezmax and Aframax flows from the Caribbean to the U.S. Gulf are going to be totally shifted out to the east. We're reluctant to agree with that. Because we believe that Venezuela doesn't really have the export infrastructure for such a massive surge in VLCC loadings. And additionally, there's limited buyers in the east to take Venezuelan crude, India being one of the few ones. So ultimately, we do see pressure on Suezmax and Aframax demand on this trade. And then for VLCC demand to the east from the Caribbean, you might see a slight uptick, but it's not going to be so great as maybe others are suggesting. So a little bit of pressure on Aframax demand in the Caribbean, but as far as transatlantic volumes, we're expecting an uptick in demand there for the reasons I mentioned before. The U.S. continues to produce crude, and I think Europe is going to need more of it next year. So all in all, we see a growth picture for dirty ton-mile demand, but it's going to be slightly lower than last year, and over the outlook, it'll continue to decelerate.
Great. Well, a lot of information there, but what about the supply side?
So we all know that there's been a oversupply of tonnage in the market. This is expected to persist into this year, but over time we do expect it to be relieved. The VLCCs in particular have a very high delivery schedule this year. We have about 62 vessels, and that accounts for vessels slipping into 2020. For the DPP fleet as a whole, we're expecting about 134 ships to hit the water. This is higher than 106 that we saw last year. And unfortunately, deletion activity is supposed to be 20% lower this year, coming off about 100 vessels last year. So the situation will improve. It'll just take some time. Last year, our net fleet growth number was about 1.5%. That's on an average inventory basis. This year, we're expecting to fall to about 1.1%, and it will continue dropping. But again, it's just going to take some time for the market to readjust.
So what will the impact on freight be?
So ultimately, the improving supply side of the market will support freight rates over time. It's not until the back end of the forecast period, though, that we see a significant upward movement. For this year, we see the VLCC trades TD3C and TD15 averaging about world scale 48. The Caribbean-Singapore trade should average about 4.7 million. But it's not until 2023 that you see the real upward movement, with TD3C around world scale 76 in that year. So for TCEs, this year they're expected to experience a slight upward movement, and that's because bunker prices are expected to come down with crude prices. But ultimately in 2020, we're going to see a lot of pressure on TCE earnings, and that's because of the switch over to low sulfur fuel oil, which is expected to price much higher than high sulfur fuel oil. So looking at the VLCC sector, we're expecting earnings of about $26,800 per day this year. In 2020, that'll move down to about $18,900 per day. But if you have a scrubber, you can expect about 70% more earnings. But then when we get to 2023, we see more of an upward movement with VLCCs averaging about $51,300 per day. Now for the Suezmaxes, it's a similar type of behavior. This year we see them averaging about $18,800 per day, and by 2023, about $28,000 per day.
Well, that's very interesting information, Connor. We appreciate you stopping by and giving us your current views in the market.
No problem. Thanks for having me.
I'm Claire Schmidt, and that wraps up another edition of McQuilling TV. Thanks for tuning in.